Okay, so welcome to everyone. Thank you for joining. Today we're going to go straight into the test question. So we're covering test one, FAC 4864, 2017. It's a question on an income statement. And so I'm going to show you how to answer the question, how to think through the question. I'm going to show you when you read the scenario, how to read the scenario. So I think you get like 10 minutes or 15 minutes of reading time. So how to utilize that time. So pay careful attention as to how I read, but I will also highlight it to you to show you what to pick up, what to think about, what to write down as you're reading the scenario. And then we will read the required, and then from there we will answer the question paper. So I'm going to get straight into it. Um, so if you want to, you can open up that question paper. I was going to open up my side. I already have it open. Need to find it. Okay. So I'm going to share this. I'm going to share my screen with you. I'm going to share my screen. Okay, so you should see my screen here in front of you now. Um, so it is FAC 4864. It is a test 1 2017. In this start letters on page 89, question 3. We're only going to focus on part 1, 28 marks. So I'm going to I'm going to go a bit slow through it, and I'm going to show you how to think through the scenario. So by practicing to read a scenario properly, before you even get to the required, you must already know certain things, okay? Try to avoid reading the scenario just for comfort's sake. So I know many of us, we read a scenario just because we have to read the scenario. Try to utilize that 15 minutes as best as possible. You can't write anything in your answer books, but on this, to make a mental notes or to make notes on your question paper, you certainly can do that. So try your best to understand the scenario at the end of the 15 minutes. It is not an easy task to read a scenario and then to understand it, but as you practice, it will definitely become easier. An approach to understand a scenario and to practice to understand a scenario is to read paragraph by paragraph and understand what that paragraph is telling you, and try to understand what they are saying. In some paragraphs, there are just too much information. In that case, you go sentence by sentence. So just try to practice that. Don't just read. Don't just think, okay, 15 minutes and you want to rush through the scenario. But you don't also want to take too long. You don't want to read like you're sitting on the beach. Okay, you can't read like you're sitting on the beach, nor can you read as if you're reading for a speed reading test. So you mustn't be on either ends. So try to be somewhere in the middle where you read within 15 minutes, but when you're done reading, you have a good understanding of what the scenario is about. I'm not saying you must know it 100%, but you must have a very good understanding of it. If you can do it for the first time in the exam, it's not going to work out. So as you practice your question papers, make that one of the checklists on your to-do list or on your study schedule. Make one of the things that you must master, and that is to understand a scenario, to read a scenario with understanding. As you get better at reading a scenario with understanding, your time should you should be reading it quicker. So that means maybe after the first time you may take 30 minutes to read the scenario, but as you become better at it, you will then shrink it till you get into that 15 minutes. The same should apply. The same will apply to reading the required. Why this is important? Because remember, on the day of your tests and on the day of the exam, you first get the scenario, and then you will get the required. So make sure when you read the scenario, you actually have a good gauge of what the scenario is about. You highlighted some things. On highlighting, don't overdo highlighting, because I know some people highlight to a point where the unhighlighted part becomes the important part, because the whole paper is highlighted So it makes no sense. So highlight cautiously. Okay. I don't say don't highlight, but don't also highlight to such a point where the only thing that stands out is the part that is unhighlighted, because then you're defeating the purpose. So practice this, and you will become better at it. Similarly, with the required, read the required and try to understand what the required is asking. Try to break down the required piece by piece to make sure you cover everything. Take your time with it till a point come when you read the required, your brain is automatically formatted to read the required in a certain manner, and will pick up all the bits and pieces. Why this important? It may have a longer view to read the required thoroughly, but there's two parts. One is going to help you now, and the second one is going to help you in 2 to 3 years' time. The one that is going to help you now is, according to ITC comments, right? So a lot of the lecturers, same at UNISA, they would have they mark papers for psychers ITC exams. So our lecturers used to tell us of all the common mistakes that would be made. And one of the themes that came out basically every single year is the problem where um, people, because we get the scenario before the time, we kind of read the scenario and we try to come up with a required. Now, in some instances, or quite a few instances, the actual required is very different to what you and I thought the required would be. But many students, many of us, we will still answer the actual required based on what we thought the required would be. And then in the end, we end up not getting the marks and we end up failing. So by practicing to read a required properly, it will mitigate that factor to a substantial degree. So practice that. The second reason that I said will help you in 2 to 3 years' time, depending when you write board two, is that if you miss parts of a required in the board two exam, you will fail. So remember, the board two exam currently is based on competent, not competent, well, various degrees, but it's either you're competent or not competent. And one of the ways you can be judged not competent if you don't answer all the questions, if you don't answer every part of a required. So for example, the CEO sends you an email and asks you for 4 things, but you answer only 2 things. So if you consistently do that, they'll mark you not competent because you're not reading the required. You're not answering all the things that they've asked you for. So just practice that. And this is a common mistake in auditing, that many people write the right answer down, but it's wrong because it doesn't answer the actual required. So what they answered based on what they thought they read, that is correct. But unfortunately, they can't get the marks because it's not what the required asked of them. So it comes down to actually reading the required. And that's why with me, I stress the 2 parts, reading the scenario with understanding, and then number 2, reading the required. And that, coupled with understanding your content, is going to help you so much better. So please, it's not just about answering the question. You must learn 4 things. Number 1, understand the required. Number 1, understand the scenario. Number 2, understand the required. Number 3, be able to answer based on the theory you know. And number 4, develop an exam technique. If you have those, automatically you'll be able to finish a question within time. If you're struggling to understand the required, if you're struggling to understand the scenario, because if you struggle to understand the scenario, you're not going to know where to find information. That's going to slow down your time to answer a question. And then if you don't know the theory that well, or if you don't have an exam technique, that's also going to slow down your time. So by working on those 4 factors, it's going to help you to get better marks, and it's going to help you to finish an exam paper. So try to focus on the fundamentals, and all the other building blocks and not just focus on running through a million questions and focusing on just running through different theories. Work on all of those aspects. So remember, 1% in every aspect will have a better improvement overall. So like they say, I think a psychologist or someone would say, or sports coaches would say, don't increase 10% in one area, rather increase 1% in multiple areas, and that will result in a far better result for you. So my part to that would be focus on those four areas: understanding the scenario, understanding the required, learning your theory properly, be able to apply it, and then number four, developing an exam technique, improving your exam technique. All of those four aspects will certainly help you to answer an exam question, to complete an exam question. And I can prove it. You can prove it to yourself. Pick a question that you really know well. So let's say you know WAC really well and practice a WAC question. You will prove to yourself that you will finish the WAC question within time, if not a minute or two to spare. That is proof to you that when you know something well, when you set it out really well, when you understand the scenario really well, you will be able to finish it within time. But now you must do this in every other topic. And then as a whole, you will come out really, really strong. So see, when you think big picture. Don't just think in terms of theory. Think of all the components that makes up the exam. It's not just the theory, it is all that other components as well. So pay careful attention as to how I read. I will point out to you as I read important things, like I have been doing paragraph by paragraph, identifying the key components. In certain paragraphs, there's just too much information. Then we go sentence by sentence. So now we're going to start, and then I'll also show you how I suggested a way to set out the solution. Remember, it's not, you can pick your own way of how you want to set it out. But anyway, let's get going. So we're going to do part 1, 28 marks. So they say Chevy is a South African company listed on the JSE Limited. Chevy specializes in the restoration and sale of classic motor vehicles. All companies in the Chevy group have a February year end. So there's just some background in that paragraph. Nothing much for us, but I think the one important point would be that we have a February year end. So that's an important aspect. Other thing just to note, they are saying that it is a listed company on the JSE. For a financial reporting point of view, for our point of view, there's no real importance. In the real world, from a financial reporting point of view, that is relevant. Remember, for a listed company, there's two things that applies to a listed company for financial reporting purposes. That is earnings per share, and it is segmented reporting. So those two standards is specifically applicable to listed companies. Earnings per share used to be part of our syllabus, but I think in 2017, SAICA removed it. So the listed part, from a financial management point of view, from a MAC point of view, valuations point of view, being listed or not listed plays a critical role in valuations. And then from an auditing point of view, being listed has its additional risks. Okay, so just keep that in mind. Then the next sentence says Chevy specializes in the restoration and sale of classic motor vehicles. So what you should know, that from a financial reporting point of view, not from a group point of view, not from a group accounting point of view, but from your FAC 1 or FAC 3 point of view, this would be inventory to Chevy. So this because they specialize in the restoration and sale of classic motor vehicles would be then inventory to the company. Okay. But what's important for us in this question is that we have a February year end. So let's go to the second paragraph. Chevy acquired 70% of the ordinary share capital of APAC. I don't know how to pronounce the name. I'm just going to call it APAC on 30th June 2015 for a cash consideration of $885. Apex retained earnings amounted to 1,085,000 Rand on the date of acquisition. The fair value of the non-controlling interest on that date amounted to 365. Apex assets and liabilities were deemed to be fairly valued on the acquisition date, and no additional assets, liabilities, or contingent liabilities were identified. From 30th June 2015, Chevy exercised control over APAC as per the definition of control in accordance with IFRS 10 consolidated financial statements. Now, that paragraph has a lot going on. Reading that paragraph, like I just read it, it's messy. So in such a paragraph, we go sentence by sentence. We don't have to go exactly sentence by sentence because we read the entire paragraph. We kind of have an idea of what the paragraph is about. So we can pick up the key things. So one of the key things here is that last sentence. The last sentence is from 30th June 2015, Chevy exercised control. So remember, Chevy exercised control over APAC from 30th June 2015. This links back to what we did on day one, where we identify the type of influence. So the type of influence over here is control. Control means we have a subsidiary. A subsidiary means we have to consolidate. So that means Chevy have to consolidate APAC. Okay. Why must Chevy consolidate APAC? Because Chevy is the parent and APAC is the subsidiary. Chevy acquired APAC. Okay. So when did we exercise control? From 30th June. So that date, 30th June, is an important date. That date is the date of acquisition. What is the importance of the date of acquisition? The date of acquisition means from that date we need to apply whatever accounting we need to apply. In this case, we need to apply consolidation. Okay. From this date, we need to consolidate. So just be aware of that. Now, remember, from the date of acquisition, or on the date of acquisition, we need to apply IFRS 3. IFRS 3 deals with business combinations. Business combinations says we need to apply the acquisition method. The acquisition method has 4 parts. Number 1, identify the acquirer, meaning who controls who. Who is the parent? Who is the subsidiary? In this case, we have identified the acquirer. The acquirer, the parent, is Chevy, and the acquiree, the subsidiary, is APAC. Number 2, identify the date of acquisition. The date of acquisition is the date when you exercise control. The date when we exercise control is 30th June 2015. Number 3, we need on the date of acquisition. Sorry. Sorry, guys. On the date of acquisition, we need to measure all assets and all liabilities at the fair value. Okay. And then number 4, calculate goodwill. We're not going to worry with goodwill in this case. But so what do we know? We have control from the date from 30th June 2015. That means we have a subsidiary. That means we need to consolidate from that date. They're telling us that we acquired 70%. Remember, that means the parent gets 70% of the profits and the NCI gets 30%. Okay? But sorry, my sinus. Consolidation means we need to bring on 100% of the assets, liabilities, income, and expenditure, not 70%, 100%. So assets will be 100%, liabilities will be 100%. In the income statement, all income and all expenditure will be 100%. At the end, we will then split between NCI and equity, NCI and parent. So just be aware of that. In order to calculate goodwill, we need the consideration. They told us what the consideration is. Can I just pause this here? I just need to get a tissue as I'm going to be. So to pause this quickly. Okay, guys, I'm back. Sorry about that. My nose are just messed up. Okay, so we said we gain control on 30th June 2015, so we have to consolidate. Consolidation means we have to bring on 100% of the assets, liabilities, income, and expenditure, even though we only have 70%. In order to calculate goodwill, we have the consideration, which is 885 at the date of control, at the date of acquisition, they're giving us what the retained earnings is. Okay. Then over here, they're telling us that the fair value of the non-controlling interest on that date, on the acquisition date, amounted to 365. Now, what you should know that when you think about NCI at acquisition, you must remind yourself that NCI at acquisition can be measured in two ways. Number one, can be measured at fair value. Number two can be measured at their proportionate share of the net identifiable assets. Okay, or their proportionate share of the fair value of the net identifiable assets. When they tell you this fair value, it may indicate, but to confirm, you need to read the policies right at the bottom. Don't just assume, just confirm. Because they can give you the fair value, but the policy could say that they're using the proportionate share. So just take note of that. Okay. Then I want to talk about this thing over here. Apex assets and liabilities were deemed to be fairly valued on the acquisition date, and no additional assets, liabilities, and contingent liabilities were identified. As we discussed yesterday, that one of the four things of applying the acquisition method in terms of IFRS 3 is that we have to recognize and measure assets and liabilities at fair value. But which assets? All identifiable assets and liabilities. Now, here they're telling you that all assets and liabilities are at fair value. That means we don't need any fair value adjustment. They're also telling you that there are no additional assets, meaning there's no other identifiable assets that we have to recognize. There's no other liabilities that we have to recognize, and there's no contingent liabilities. Remember the example I gave you yesterday? If someone buys Coca-Cola, on Coca-Cola's balance sheet is no brand called Coca-Cola. But when someone buys Coca-Cola, they're certainly buying that brand. That brand name Coca-Cola would be an additional asset. But in this case, this company does not have brands and so forth that needs to be recognized. So just keep that in mind. And similarly, this company does not have contingent liabilities. Like we said, contingent liabilities is not presented on the statement of financial position, but rather disclosed in the notes to the financial statements. But when there is a business combination, certain contingent liabilities needs to be recognized as a liability. So that is why you will see that sentence often, that all assets and liabilities are fairly valued at the acquisition date, and no additional assets, liabilities, or contingent liabilities were identified. They will generally always tell you that, just to meet that point number three, in terms of IFRS 3. So just keep that in mind. You will see in the next one, they'll say that same sentence, and then we'll just have a comma and say except for. So just be aware of that. Okay, so in that paragraph, there was a lot going on. So to recap, that we gained control, therefore we need to consolidate. The date we gained control, which is the date of acquisition, is 30th June. So from 30th June is when we need to consolidate, and on 30th June is when we need to apply IFRS 3. We identified that NCI's fair value is 365, but we need to confirm whether that is the policy to measure NCI. We picked up that Chevy acquired 70%, But remind yourself that although they acquired 70%, consolidation still means we need to bring on 100%. And then we know the consideration, we know the retained earnings at acquisition, and then we also know that all assets and liabilities are at fair value, and there are no additional assets or no additional liabilities. Okay, so just keep that in mind. Now we go to the next paragraph over here. Chevy acquired 65% of the ordinary share capital of Chevelle on 30 April 2016 for a cash consideration of 1,060,000 rand. The fair value of the non-controlling interest, the fair value of the non-controlling interest on that date amounted to 570,000 rand. The acquisition of Chevelle resulted in the recognition of goodwill in the consolidated financial statements of Chevy. From 30th April 2016, APAC exercised control over Chevelle as per the definition of control in accordance with IFRS 10. So once again, what do we know? That Chevy gained control. No, what is happening from the APAC exercise control? So this is quite confusing. Okay, so they mixed up this whole thing over here. Because in the first part over here, they're saying Chevy acquired 65% of Chevelle, but here they're saying APAC exercised control over Chevelle. So we can assume that this here of APAC needs to be Chevy. Okay. So here we can see that, so this must be Chevy, not APAC. So Chevy exercised control over Chevelle. So there we pick up, we have control. That means we are a subsidiary. That means we need to consolidate. When did we exercise control? From 30th April 2016. 30th April 2016 is the date of acquisition. So that means on 30th April 2016, we apply IFRS 3 on so on 30th April 2016, we apply IFRS 3, and then from 30th April 2016, we have to apply IFRS 10. So just keep that in mind. We acquired 65%, and the non-controlling interest is measured at fair value to 570,000. Remember the fair value amount for NCI. It is most likely that they measure NCI at fair value, but what's important to note is that we have to first confirm when we look at the notes, what is the policy of the company. So we picked up a few things over there, and we can see there's a consideration of 1 million. So always, what's the important stuff to pick up is to look what is the type of influence, and then number 2 is to identify the date of acquisition, because the date of acquisition will tell you when to start applying the appropriate accounting treatment. Okay, and the type of influence will tell you what type of accounting treatment you need to apply. That's very important. Then to calculate goodwill, you're going to need your consideration, you're going to need the percentage, and you're going to need to know how NCI is measured. Let's read the next part. So here they say Chevelle's assets and liabilities were deemed to be fairly valued on 30th April 2016, with the exception of the following. So you can have a look over here. If you look at the one with APAC, what did they say over here? They're also telling you APAC's assets and liabilities were deemed to be fairly valued. Here they're saying also deemed to be fairly valued, but now they have another part called with the exception of the following. What is the exception? The exception is that the equipment was revalued with 134,000 Rand more than the carrying amount. The remaining useful life of the equipment on 30th April 2016 was 3 years. The equipment is used in the production of income. Okay, so just keep that in mind. Now let's go into our intergroup transactions. And then they're just telling you this over here. No additional assets, liabilities, or contingent liabilities were identified. So that sentence is going to come often through. Okay, so just be aware and remind yourself, what does that mean? That means that that point number 3 of the acquisition method. Remember, the acquisition method had 4 parts. So the third part, to recognize and measure all assets and liabilities at fair value. Okay, all identifiable assets and liabilities at fair value. So that no additional assets, liabilities, or contingent liabilities were identified. That is talking to that identifiable aspect. So please make sure you know what that means. So here they're saying the following intergroup transactions took place within the group during the year ended 28 February 2017. So now we get an idea that we are in the financial year 28 February 2017. So that means our financial year begins 1 March 2016 to 28 February 2017. So an important aspect to note in the Chauvel case is that we acquired Chauvel in the current year. So point number 1, from 30th June 2015, APAC has been selling inventory to Chevy at a cost price plus 20%. Included in the closing inventory of Chevy on 28 February 2017 was inventory amounting to 132,000 rand, 132,500 rand. In 2016, 87,400 that was purchased from APAC. So now we need to think, who is selling to who? APAC has been selling to Chevy. So subsidiary is selling to parent. Okay. That implies that APAC is making the profit. So that means the subsidiary is making the profit. That means that the transaction is arising in the subsidiary, and that means if there is an impact on profits, the NCI will share in that impact. So just be aware of that. Then they're saying during the 2017 financial year, sales from APAC to Chevy amounted to 335,200. Okay, so remember, when it comes to inventory, so bullet point 1 and bullet point 2 both deal with the inventory intercompany journal entry. The inventory intercompany journal entry has 3 parts. Number 1, eliminate the intercompany sale. So we will eliminate bullet point number 2, which is saying debit sales, P&L, 335,200, credit cost of sales, P&L, 335,200. Okay, so that's the first journal entry of the intercompany inventory transaction. The second the second and the third journal entry relates to eliminating the unrealized profit sitting in inventory. So the inventory intercompany journal entry has 3 parts. Number 1, eliminating the intercompany sale, and that is bullet point number 2. Debit revenue, debit sales, credit, cost of sales, 335,200. Journal entry number 2, journal entry number 3 is to eliminate the unrealized profit sitting in closing inventory. Okay, so the second journal entry will relate to the closing balance of the current year, and the third journal entry will relate to the closing balance of the prior year. I'll do journal entries with you when we answer the question. Then we have APAC. Bullet point number 3. APAC acquired land to the value of 700,000 Rand on 1 August 2016 for investment purposes. The land is currently used by Chevy as a scrapyard. Based on the valuation performed on 28 February 2017, the investment property's value increased with 100,000 Rand. So what APAC is doing, APAC has land and they're using it for investment property purposes. So remember, a fair value gain on investment property, if they are using the fair value model, goes through P&L, goes through profit or loss. The problem comes in when we do group financial statements. So APAC has land as investment property. This land is being used by a separate legal entity, Chevy. So from Chevy's point of view, because Chevy is using it as a scrap yard, it will be PPE. Okay, but ignore that for now. So from a group perspective, that land can't be investment property. From a group perspective, that land can't be investment property. What is investment property? The definition of investment property is you're holding land and buildings, you're holding property for the purposes of one of two things. Number one, either for rental purposes, number two, for capital appreciation. Now, from a group perspective, this land is being used by Chevy. Any any asset that is owner occupied is considered to be PPE. So you must just get this straight in your head. From a separate legal entity point of view, we have APAC that has this land as investment property. Then we have Chevy who's using the land. From separate legal entity purposes, totally fine. Now, when you're doing a group perspective, Chevy and APAC become one entity, one economic entity. Being one economic entity, we need to ask ourselves the question, how is this land being used by the group? Is this land being held for rental purposes? Is this land being held to earn capital appreciation? And the answer is no, it is not. The answer is it is owner occupied because Chevy is using the land. That means, from a group perspective, this land is not investment property, but it's rather PPE. Now that becomes an issue. What is the issue? From a balance sheet point of view, from a statement of financial position point of view, you're going to have to process a journal entry. You're going to have to credit investment property and you're going to have to debit PPE. Why is this the case? Here's where the starting point, end point thinking comes into place. What is my starting point? My starting point is 100% of the parent, 100% of the subsidiary. Now, this land is sitting in APAC, which is the subsidiary. So my starting point of the subsidiary would have investment property. My end point is what the group wants. So the way the group see this land is not as investment property, but rather as PPE. Why? Because this land is owner occupied. So my starting point as investment property, my end point, which is the group annual financial statements, is PPE. So how do we fix this? We have to use the vehicle, and that vehicle is pro forma journal entries. So the pro forma journal entry to fix this would be remove investment property. So you credit investment property because investment property is an asset. An asset decreases on the credit side. We want PPE. So that means PPE needs to increase. PPE is an asset increase on the debit side. So you're going to say debit PPE, credit investment property. That's the balance sheet point of view. Now we need to consider the income statement point of view. To consider the income statement point of view, we'll have to first see how do they treat each type of asset. If investment property is measured at fair value, which we're assuming it is because they're telling us the value increased by 100,000, but we'll confirm when we read the company policies. If it was at investment property, APAC would have said debit investment property, credit fair value gain, P&L. Now, because it's not investment property, we can't have a fair value gain, so we're going to have to eliminate that fair value gain. And then we'll have to have a look, how does the company how does the group measure PPE? Okay, so we will come to that when we read the investment property. So just remember that. This is going to be a typical thing that you must be aware of. You need to ask yourself, who is using or how is this asset being held or used or utilized by the group? So keep in mind, from a separate legal entity point of view, from a non-group perspective, this property is held as investment property. From a group perspective, this property is not investment property, it is PPE. Why? Because the land is owner occupied. How is it owner occupied? Chevy is using it as a scrapyard. So that's a typical example. Please be aware of it. Let's move on. Chevy sold office furniture to Chevelle on 1 November 2016 for 14,000. The original cost price was 15,700. The furniture was originally purchased on 1 September 2015 and had a useful life of 5 years. Okay. Here, Chevy is selling to Chevelle. Parent is selling to sub. Because the parent is selling, the transaction is taking place in the parent, the profit is sitting in the parent. So any impact on profit will not impact NCI because NCI does not share in the profits of the parent, but only share in the profits of the subsidiary. So please be aware. When there's a sale of a depreciable asset, there's two parts. Number one, eliminate the profit or loss on the sale. Number two, you need to make an adjustment to depreciation, okay, as a result of that profit or loss. But we're going to do that when we cover the question. So they say the separate trial balances of the various companies as at 28 February 2017 are as follows. We have ordinary share capital, we have retained earnings on 1 March 2016, which is the beginning of the financial year. We have a revaluation surplus, we have gain on property valuation, other comprehensive income, we have deferred tax, we have trade and other payables, we have profit before tax, we have land, we have investment property, we have equipment at carrying amount, office furniture at carrying amount, investment in APAC, investment in Chevelle, inventory, trade and other receivables, cash and cash equivalents, income tax, and then dividends paid. One thing to note, you must pay careful attention to this, they're never going to tell you. Under the intercompany transactions, they didn't talk about dividends received, okay? But you understand that Chevy is a shareholder in APAC. Chevy is a shareholder in in Chevelle. So when APAC pays out dividends, automatically dividends will be paid to Chevy because they're a shareholder. You pay dividends to your shareholder. Similarly, when Chevelle declares a dividend, Chevy will get their percentage. So remember, of the 60,000 Rand that APAC pays, 70% of that is sitting in other income, sitting in Chevy's other income. And 65% of this is sitting in Chevy's other income. So remember, you have to eliminate dividend income as well. It's never going to be sitting under intercompany transactions. You have to just make a note for yourself that when you read dividends paid, remind yourself that there's going to be intercompany dividend income for the parent. If the subsidiaries declared a dividend, in this case they did, so the parent received their percentage. So we need to eliminate that because you can't receive a dividend from yourself. Okay, additional information. Chevy Group applies the following policies. This is important. Equipment and office furniture is in the cost model. Land using the revaluation model, so that's going to have an impact. Land, okay. Depreciation on furniture, straight line method. Investment property, the fair value model as we expected. Non-controlling interest, measured at fair value at acquisition as we expected. But we needed to confirm. It is the accounting policy of Chevy and APAC to account for investment in subsidiaries at cost in accordance with IAS 27. Remember, the parents in their separate financial statements have to apply IAS 27 when accounting for the investment in a subsidiary, an associate, and so forth. So in the parents' separate financial statements, they have to apply IAS 27 to account to account for the investment in a subsidiary or an associate or a joint venture and so forth. IAS 27 gives you two options. Option number one, to account for an investment at cost or in terms of IFRS 9. So it's either at cost or in terms of IFRS 9. IFRS 9 has a further two options. IFRS 9 says you have to measure at fair value, either through profit or loss or through other comprehensive income. Okay, yeah, or through OCI. Okay, and then number three, Chevelle's income and expenses accrued evenly throughout the year. The relevance of that is that we acquired Chevelle during the financial year. So all the profits won't come to the group only from the date of acquisition. So we acquired them on the 30th of April. So that means we had them for 10 months. So we can only account for 10 months, or we can only consolidate 10 months of the profits. We can't consolidate 12 months because we did not have control for 12 months. We only had control for 10 months. Then we have assume that dividends, all that kind of stuff. There were no changes. Okay. For our purposes, I don't think this ever changes. Yeah, in the real world, this changes. For our purposes, it don't change. For CTA 2 students, for CTA 2 students, CTA 1 as well, but particularly CTA 2, I just want to bring your attention to this. It does not mean that we have more than 50% that we have control. CTA 2 students, please be aware of that. It does not mean that we have more than 50% that we have control. We can have 100% and we can't have control. Okay, there's instances where you can have 100% and you still don't have control. So it's important for them to tell you whether you have control or not. Okay, CTA 2 very important. CTA 1 maybe. Undergrad not so much. Don't have to worry about that. For an undergrad, if you have more than 50%, you will have control. CTA 2, be aware of that. It does not mean that you have more than 50% that you have control. You can have 100% and you still don't have control. So they have to tell you, they must give you information for you to determine. How do you determine control? How do you determine control? You have to read through IFRS 10. Okay. So let's go to the required. We're only doing part one. So part one says, prepare the consolidated statement of profit or loss and other comprehensive income of Chevy Ltd Group for the year ended 28 February 2017, starting with the profit before tax. So they're telling you what to start with. Other comprehensive income should be presented net of tax. This you must know. This you learn in Fact 3 or Fact 1, depending which CTA you're in. This is in Fact 3 or Fact 1. And in Week 1 or Week 2, you do the conceptual framework and they do presentation of financial statements and so forth. In presentation of financial statements, IAS 1, they talk to you about this. So just be aware of that. Okay. So what's important to note, they ask you to prepare. They didn't ask you to calculate. Calculate means you can do it however you want to. Prepare means you have to do it how it actually needs to be done in terms of IFRS. Okay, so that is what we're going to do. What must we do? We must prepare the profit or loss and other comprehensive income statement. So that is what I'm going to do with you guys now. And then I'm just going to share my Excel. Okay, so here we go, guys. You should be able to see Excel. So what they're asking us to do is to prepare the statement of statement of comprehensive income. So remember, when you prepare financial statements, there's three things: company name, statement name, and then date. So what's the company name? Chevy Group Ltd. Consolidated statement of profit or loss and other comprehensive income. Comprehensive income for the year ended, and then you put the date. I just put my date over here. You write it in one full sentence, doesn't matter. February 2017. In the real world, you're going to put the date next to year ended. I'm just putting it here just to show you the three aspects. Important things to know that every statement is for the year ended or for the period ended. Only the balance sheet, only the statement of financial position is as at. Okay, so be aware of that. They told us to start off with profit before tax. So we're going to start here, profit before tax. Then we're going to have income tax. Then we're going to have profit after tax, or you can call it profit for the year. Doesn't matter. Then we will have other comprehensive income, other comprehensive income. And we saw the thing that was there was gain on property, something like what? Let us see again. It was that gain on property valuation. So that was there. Let me just go back. So it was gain on property valuation. I'm going to leave a space just in case there is something else. I'll just let them know net of tax. Okay, I'm going to leave a space just in case. Then I'm going to say total comprehensive income. Now I need to split this. So I'm going to say profit attributable to, profit attributable to. Attributable to who? To parent, to NCI. I'll explain this now. Then we're going to say total. And we're going to say total comprehensive income attributable to. Total comprehensive income attributable to, and then we're going to say to who? To NCI, to parents and NCI. So why do we do this? Remember that, what do we need to remember? We need to remember that, what do I want to say? Oh, so what we need to remember that we are consolidating. We are doing group accounting. When you do group accounting, when you have a subsidiary, you consolidate. Consolidation means you bring 100% of the assets, liabilities, income, and expenditure of the subsidiary onto your books. Okay, even though you don't have 100%. So this line item over here, that profit for the year, that total comprehensive income is a total comprehensive income and a profit representing 100% of the subsidiary. Then we're telling the users of financial statements of that profit, what portion belongs to NCI, of the total comprehensive income, what portion belongs to NCI. That's useful information for users of the financial statements. Okay, so just be aware of that. So there's a setup. Now we can do the workings. Now there are different ways to do the workings. I'm going to show you the way I would do it, and then I'll explain to you another approach, the way Lisa does it, And then you can decide for yourself which one you find more comfortable. Okay, mine does involve an extra step, but for me personally, and like for many other students as well, that extra step is actually brings you more marks and save more time because it involves less thinking. Okay, so so when I say less thinking, I'm not saying you must not think. I'm just saying that you practice and you think hard when you study. But when you write the exam, you want little thinking. Okay, you just want to write and think naturally, okay? And not because remember, under an exam pressure, when I'm sure you know how you feel when you're writing under exam pressure, lot of information, time, the actual result you need to pass, all of those stuff, your blood pressure, your sugar levels, you are stressing. So you're gonna forget and you may miss information in time, and it will be information that you wouldn't ordinarily miss. So you want to set yourself up for greater success by trying to manage that. So your choice, how you want. I'll show you how I would approach this. So now we're going to calculate profit before tax. We're going to start off with that figure. And we're going to have to make every adjustment that we would have made. So remember, to get to profit before tax, the income statement looks like this: sales, cost of sales, gross profit, other income, other expenses, profit before tax. So intercompany transactions would have gone against sales and cost of sales, other income, and other expenses. In this case, we're not adjusting sales, cost of sales, other income, other expenses. We are rather adjusting profit before tax because that is our starting point. So that's very, very important. So I'm going to have a sort of new sheet to work out my, I'm going to have a new sheet to work out my, my what? My, my workings. So here I'm going to do my workings. So here, working one. So how I do it, I do separate profit calculations for each entity, okay? So I do a separate profit calculation for each entity. So this would be profit for Chevy. And then I would have another working, I would have profit for APAC, however you say that. And then I'll have another working profit for, who was the other person now? Chevelle. So this here is working 2, and then that here I will have working 3. What do we know? Our starting point is profit before tax. Remember, this is a working, I'm using shorthand. The starting point, profit before tax, profit before tax, okay? I have another column and I just put in the tax impact over here. Then I have a final column, which is my profit after tax. So I just do the calculation all in one with having, by having a, I don't know if you use Excel, but having Excel will help you. See that you're most likely like online. I don't know, some of you might use Excel when you write online, some of you still make using paper, but even if you don't, even if you're writing your exam using paper, setting up your solution in an Excel format is very beneficial. What did I just do here now? Sorry. So let's go through this, okay? I just want to just remove this. Profit before tax, profit before tax. So I'm going to start off with the profit before tax for each entity, okay? So when I look at the information, somewhere there can be profit before tax. So as you can see, profit before tax is for Chevy 20, let me just see now, 2561, 822. The profit figure is inside of brackets because they credit. Credit means we have a profit, not a loss. Okay. So that's my profit before tax for Chevy. Then the profit for APAC was 1152 200, 1152 200, also a credit. And then for Chevelle 793 600. Chevelle is 793 600. But now remember, for Chevelle, we didn't have for the full year. We acquired Chevelle in the current year. We only had 10 months of it. So we need to say multiply by 10 divided by 12. Okay, so now I can do that. So my starting point, if we think in terms of that approach, starting point, end point. What is my starting point? 100% of the parent, 100% of the subsidiary of the trial balances as at the end of the current year. So in my starting point, I would have the profit before tax of Chevy, the profit before tax of APAC, the profit before tax of Chevelle, 100%, okay, based on the current year trial balance. I'm trying to go from starting point to end point. What is my end point? My end point is the group annual financial statements. Now, if you think back to day one, when I drew that diagram, the diagram would look as follows. Chevy on top, and then you will have APAC and Chevelle. Each of them had transactions with each other. Those transactions with each other from a separate and an individual's financial statements point of view is perfectly fine. But now, so now included in all of these profits, included in Chevy's 2.5 million, included in APAC's 1.1 million, included in Chevelle's 600,000 is the profit figures of as intercompany transactions. Now that from a separate, an individual company point of view, it is perfectly fine. Now we are doing our group financial statements. The group financial statements become a big square box around all of them. And we want to remove any transactions between ourselves because we are now one economic entity. We only want transactions with those outside of the group. So there are two types of transactions, two types of group adjustments that we're going to deal with. Number one, any adjustment relating to at acquisition. And then number two, any adjustment relating to intercompany transactions. So let's deal with intercompany transactions, and then we will deal with any transactions at acquisition. So let's go to the intercompany transactions. And the intercompany transactions are these 4 bullet points over here. So in the bullet point number 1, there is a unrealized profit of 20% sitting in opening and closing inventory. What we should know, the profit is sitting in APAC's, in the subsidiaries profit figure, and we need to remove it from the subsidiaries profit figure. So what we would do, we would go to the profit figure of APAC. We'll go to the profit figure of APAC, and we're going to adjust for closing inventory. So here we will say eliminate unrealized profit included in closing inventory. You don't have to write this so much. I'm just for purpose of understanding. So what we will do over here, we're going to say equal to 132,500 Rand. That is the closing inventory, but we're not going to remove the full closing inventory, we're only going to remove the unrealized profits included in the closing inventory. So what is the unrealized profits included in the closing inventory? It is at 20%. So it's 20 divided by 120. Because it's 20% on cost price, it is divided by 120. If it was on selling price, it would be divided by 100. So that is what we're going to do. We're going to remove that. Now remember, we want to eliminate the profit. We currently have that profit. We don't want it. We want to remove it. So what is, by removing it from profits, profit is going to decrease. So therefore, we make it negative. So that is accounting for the unrealized profit in closing inventory. Now we need to eliminate the unrealized profit relating to last year's closing inventory. What you should know, it is assumed that last year's closing inventory, it is assumed that the unrealized profit included in last year's closing inventory has actually been realized this year. So the assumption is that the unrealized profit included in last year's closing inventory has been realized this year. So what we need to do, we need to add back that unrealized profit. Think about it this way. Last year's closing balance is this year's opening balance. We're assuming everything in the opening balance has been sold. Even if it had not been sold, even if it was not sold, it would be included in this closing balance over here. And that is the reason why we have to add back the unrealized profit of last year and realize it this year. So just remember that. So we're going to say realizing the profit included in opening inventory. So opening inventory was 87,400 multiplied by 20 divided by 120. Once again, because it's on cost price, we say divide by 120. If it was on selling price, we say divide by 100. So I need to say equal to. And we're going to leave this as a profit because we are realizing that figure. We are assuming that we actually sold it to people outside of the group. So we're actually making the profit this time. So therefore, we need to add it back. So just be aware of that. So that deals with this over here. So remember in this paragraph, in the first bullet point of the intercompany transactions, it is the unrealized profit sitting in opening and closing inventory. So we dealt with that. In bullet point number 2, when we want to work out a profit figure, we're only working out profit before tax. So because we're working out profit before tax, we don't have to account for this 335, because remember, it is a decrease to sales and it is a decrease to cost of sales. The net impact on profit is 0. So we don't have to make the adjustment. If, however, we started with sales and cost of sales, then we would have to adjust for this figure because we are not starting with sales and cost of sales. There's no need to adjust for that figure. So just be aware of that. Now we're going to go to bullet point number 3. So they're saying APAC acquired land to the value of 700,000 Rand. And this is the investment property sitting in APAC's books. Okay, so in APAC's books, there's a fair value gain of 100,000 Rand. That fair value gain relates to investment property. From a group point of view, we don't have investment property. And as a result, from a group point of view, we cannot have a fair value gain on investment property. So therefore, we have to eliminate that. So we will come over here. And under APAC, we're still under APAC's profit. So we will have eliminate fair value gain on investment property. Why are we eliminating it? Because of the fact that, why are we eliminating it? Because from a group perspective, we do not have investment property. As a result, any transactions relating to that investment property needs to be eliminated. So therefore, we're going to say minus 100,000 Rand. So the fair value gain was 100,000 Rand. So we eliminate 100,000 Rand. So that deals with bullet point number 3. Now we can deal with the next, the last intercompany transaction. The last intercompany transaction says Chevy sold furniture to Chevelle on 1 November 2016 for 14,000 Rand. So who has the profits? Chevy has the profits. So we're going to make this adjustment in Chevy's profit figure, the parent. The original cost price of the furniture was 15,700. The furniture was originally purchased on 1 September 2015 and had a useful life of 5 years on that date. Remember, when there's a sale of depreciable assets, there's 2 adjustments we need to make: to eliminate the profit or the loss and to adjust the depreciation. So we don't know what is the profit, we don't know what is the depreciation, so now we're going to have to calculate that. So we will have a new calculation over here. I'm just going to put it for now over there, working for. So we're going to have proceeds, and then we're going to have carrying amount. Carrying amount. Carrying amount, how do you get to carrying amount? It is cost less accumulated depreciation. Okay, so it's cost price less accumulated depreciation, and this will give us our profit or loss. Okay, so this will give us our profit or our loss. So the proceeds they told us was 14,000 Rand. Remember, the carrying amount is cost price minus accumulated depreciation. So my cost price was given to me as 15,700. I need to work out accumulated depreciation. I acquired, or Chevy acquired the furniture on 1 September 2015, and they sold it to whoever, to Chevelle on 1 November 2016. If you calculate that, it gives you 14 months. So the depreciation from the date we bought it up until the date we sold it is as follows: 15,700 multiplied by 14 months out of the total useful life. So we used it for 14 months out of the total useful life of 60 months. How did I get 60 months? 12 months times 5 years. So that is my accumulated depreciation. So we're going to say cost price minus accumulated depreciation gives me a carrying amount of 12,000. So my profit or loss, so I'm making a profit, of course, because my proceeds exceeds my carrying amount. So I'm making a profit of 1963. The profit is sitting in the parents' books. So I'm going to adjust the parents' books. So I'm going to say eliminate profit on furniture. In an exam, you're not going to write so long. I'm just for our purposes, okay? So eliminate profit on furniture. Because profit increased our current profit figure of 2.5, to eliminate it, we need to subtract it. So I'm going to say minus 19.63. Okay, so there I removed that. That's the first part, eliminating the profit or the loss. In this case, eliminating the profit. Now we need to adjust the depreciation. The depreciation is more by that profit figure. Okay, so we're going to have to decrease depreciation. So what you should know, the total useful life is 60 months. Okay, 5 5 years times 12 months gives you 60 months. From the date we bought it up until the date we sold it, we used 14 months. Okay. Number of months used is 14. Therefore, remaining useful life at 1 November 2016, that would be the difference. So the remaining useful life from the date Chevelle used the asset is 46 months. So Chevelle is depreciating the asset over 46 months. Just understand that. The total useful life is 5 years, which is 60 months. Okay. Chevy sold the machine on 1 November 2016, which means they have used the asset for 14 months. Chevelle did not change the useful life. They kept the useful life as is. So that means 60 minus the 14 months, the remaining useful life is 46 months. So Chevelle has been depreciating the asset over 46 months using their cost price. What was Chevelle's cost price? 14,000 Rand. But we know this 14,000 Rand is inflated by the unrealized profit of 1,963 Rand. So therefore, over the next 46 months, the depreciation is going to be overstated by the 1,963 Rand. So we need to make that adjustment. To date, Chevelle has used it from 1 November 2016 to 28 February 2017. That is November, December, January, February. So they have used it for 4 months. So we need to eliminate 4 months out of the 46 months of this unrealized profit. So what we will do, we need to decrease depreciation. How are we going to decrease it? We're going to say that 1963, so this amount multiplied by 4 months, Chevelle have used it for 4 months, so therefore they've depreciated the higher amount for 4 months over a useful life of 46 months. So we need to make an adjustment of 171. The question is, do we add back or do we subtract? Because depreciation in Chevelle's books is overstated, that means depreciation is higher. That means because depreciation is higher, profits is lower. So to eliminate the increase in to eliminate the higher depreciation, we need to increase profits. So just be aware of that. Okay. So just be aware of that. In this case, we have covered all the intercompany transactions. The only other intercompany transaction we must account for that is not specifically mentioned is the dividends. Okay, so here we're going to have to say, remember, APAC declared a dividend, so Chevy would have gotten their portion. Chevelle declared a dividend, so Chevy would have gotten their portion. So what we need to do is eliminate that dividend income from Chevy. We need to eliminate the dividend income from Chevelle and from APAC. So here we're going to say dividend income APAC and dividend income APAC. And then we're going to say dividend income Chevelle, and we need to remove it. Okay, so this is Chevelle. How are we going to deal with this? APAC declared a dividend of 60,000 Rand. We got 70% of that. So we want to eliminate dividend. Dividend income increase profit. To eliminate it, we must decrease profit. So we're going to say minus 60,000 that APAC declared, but we got 70% because we have a 70% shareholding. Similarly, we're going to subtract the dividend income that's included in our profit. Chevelle declared a dividend of 50,000. We have 65%. So we need to remove that. So we have covered now all the intercompany transactions. We have eliminated all intercompany transactions. The only other group adjustment we have to adjust for is anything at acquisition. Now remember, APAC had no at acquisition fair value adjustments because they told you that all assets and liabilities have been fairly valued. However, Chevelle had a property, I think, or land or something that was not fairly valued, and we need to adjust for that. So let's just have a look quickly. Where was that? So Chevelle, we had a fair value adjustment over here. We had a fair value adjustment of 134,000 Rand. So therefore, we need to make an adjustment for it. Okay. So the remaining useful life at the date of acquisition was 3 years. So we must eliminate that. So in Chevelle's books, we will go to Chevelle and we're going to say over here, what was that now? Depreciation, I think it's on land. I'm not sure what it was now. So we need to make this adjustment to land. Okay. So remember, the cost price to Chevelle is the lower amount, the amount that is not revalued. So Chevelle is depreciating based on their original cost. But from a group perspective, the group needs to depreciate based on the fair value amount, because the fair value at acquisition, that is the cost price to the group. So just keep that in mind. So Chevelle is depreciating based on their original cost price, but the group needs to depreciate based on the fair value at acquisition. Let me just see, what was that thing now? It was equipment. So depreciation on equipment. So the depreciation on equipment. So therefore, from a group perspective, Chevelle needs to process additional depreciation. How much additional depreciation? It must be depreciated, that 134,000 Rand, that revalued amount, needs to be spread over the 3 years. So we're going to say 134,000 divided by 3 years. Okay, so that's the annual depreciation. However, we don't have Chevelle for the full 12 months. We only have them for 10 over 12 months. So that's the extra depreciation. And that is covering now all the group adjustments. Remember, group adjustments are twofold: any intercompany transactions and any fair value adjustments at acquisition. So just be aware of that. Okay. So now we can work out. So I'll go here to the top. So I'm going to say, I'm going to call it profit. This is just for us to understand profit from group perspective. Profit from group perspective. Okay. And then we can split this up. What belongs to the parent and what belongs to NCI. So now if I add this up, I'm going to say sum, add all of this. I got that. I'll just do this. Okay. We'll deal with the tax just now. And I come over here. I add all of them up. And then I do the same over here. So I'll do the same over there. Then I just have another line, which I'll have total. So this is my total profit. So at this point in time, my total profit would be as follows. My total profit would be as follows. Group profit, the parents only. Group profit, the subsidiary. Group profit before tax. It is that. So that's my extra step. This is going to be my profit before tax. Sorry, this over here, because I've extra depreciation, just extra depreciation. Because I have extra depreciation, my profit must go down, so this needs to be negative. So that is my answer. Okay. So my total profit before tax is 51,454, whatever it is. And I'll just bring it in over here. Profit before tax equals 4154, whatever it is. That will be my total profit figure. Then I'll work out, now I'm going to do my tax. Okay, so now I'm going to do my tax. Once again, I'll start off with a tax figure that was given. Where was that now? So the tax figure that was given is, where is this now? 760, 320, 238. 760, 320, 238. Just if I do it wrong, just tell me. So 760, 320, and 238. Equal to 38, 1, 2, 3. But don't forget, only have 10 months, so 10 over 12. Okay, so we only have 10 over 12. Then my profit after tax is simply going to be equal to profit before tax minus tax. Okay, so I can drag this down. I'm using Excel, so I can drag down, fortunately. Now let's deal with tax. So I'm going to have 28% of that. So I'm just going to say multiply that multiplied by 28%. I can have 28%. I expect my tax to go down. Because my profit is going down, my tax is going down, so being negative, totally fine. Similarly over here, depreciation is going up. Because depreciation is going, because I'm decreasing depreciation, my profit is increasing. Because my profit is increasing, I expect tax to go up. So therefore, it is correctly a positive. On dividends, there's no tax. So remember why there's no tax on dividends. Remember, if you did dividends tax, when a company pays tax to another company, it's exempt. So therefore, there's no tax. Okay, so that's fine. So there we are sorted in that regard. Now we come to this one over here. Closing inventory. I'm eliminating profit from closing inventory, so profit decreases. Because profit decreases, I expect tax to go down. So I'm going to say that multiplied by 28%, my tax is going down. For the opening inventory, we are saying we are realizing the profit. Because we are realizing the profit, profit goes up. Because profit goes up, we expect tax to go up. So we're going to say that multiplied by 28%. Now, let's deal with this one. So we are eliminating the fair value gain. By eliminating the fair value gain, profits go down. So we expect tax to go down. So we're going to say that multiplied by 28%. But this is investment property. When there's a revaluation above cost price, that means we're now trading into the waters of CGT. So we have to still multiply this by the CGT rate which is 80%. So just be cognizant of that. So if I can do that minus that, okay, and I can just basically drag this down. Then similarly over here, profit minus tax gives me profit after tax. I'm just going to drag this down. Yeah, I'm saying we're increasing depreciation. By increasing depreciation, we are decreasing profit. Profits go down, tax needs to go down. Multiply that by 28%. And that's my tax figure. Now I can work out my total. Remember, my total is the sum of all of them. So it is the 759 of the parent. It is from a group perspective. It is the 295 from APAC from a group perspective. It is the 187,911 from Chevelle from a group perspective, which is 1242,905. I go over here. I'm going to say equal 1242,905. Profit for the year is going to equal that minus that. Okay. You must link workings. Okay, I'm going to call it working 5. Working 5. You need to link your working. So if it is wrong, then the examiner will know where to look for it. So they just call this working 5. Okay. Should have called it working 4, but okay, I have it as working 5. Okay. So, well, actually, just let's make it working 4. Working 4, and let's call that working 5. Cool. Let's do that, and let's just change it quickly. Let's make it a bit more logical. Okay. So there's the profit for the year. I'm not going to do the other comprehensive income part. I'm just going to do the split now. Now, this is the part that actually makes this thing easier. It is how to split NCI and parent. You only go to profit after tax column. So profit after tax column, parent will be their percentage. So remember, the parent gets 100% of the parent. So therefore, they get the full amount. NCI gets 0. Okay. Over here, from APAC, the parent gets 70% of the profit. So we just say multiply by 70%, and NCI will get the difference. That minus that. To do a check, you don't have to do this. I'm only doing it for our purposes. You can say that multiplied by 30% should give you the same answer, okay? So as you can see, that minus that gives you naught, okay, what we expected. And then I go to parent over here. We have 65%. And that will be total minus parent. And there we go. Now, once again, we just add up all of these. So we go to the parent. I'm going to say, I'm just going to drag this down. Just see if it works out. It's adding up all of those. Parent, 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 cool. And then it is NCI. Yep. Okay. So just be aware of that. So that's how it should be working. So if we split over here, okay. So basically NCI's portion, we just want to check quickly something. NCI is that, yeah, I think I got the right percentages, 65 and 70. So I'm going to check quickly if I say that multiplied by 35%. Okay. Okay. Yeah. So now we can go, and if we do the profit attributable to the parent, we can come over here. Parent profit figure is 286. NCI figure is the difference. Okay. It's not right. Something's not right here. Because my thing might be where's the after tax figure? What am I getting wrong here? I'm missing a number. Something's not right. Can anybody see what I'm missing? Anyone can see? It needs to be that. Let's just see quickly. Oh, that's why. Yeah, there we go. So, so that is basically how we split out the NCI. That is how we split out NCI. So that is how I do it. Is we do separate profit figures. You adjust the profit figure where the profit is, where the unrealized profit, the intercompany transaction is sitting, or where the fair value adjustment is sitting. That's going to help you also to split between parent and NCI. Then you just add up all the parents' portions, you add up all the NCI's portions, and it makes life a lot easier. The other approach that, like, maybe you need to take, they work out one profit figure, and then from there somehow they work out what belongs to the NCI. So you can decide what you prefer, but this is basically how I would do it. This is my workings, and as I work from there, I'll then plug it in to, there's working for. This is also coming from working for, so I can just plug this over here. And that's basically it. I'm not going to do the other part of gain. It's like only 3 marks. You guys can work through that. Do you guys have any questions? If you don't have any questions, we will stop there for the evening. If you do, you can ask me. But otherwise, if you don't have, you are welcome to leave if you're ready to go. Okay, so there are no questions. Okay, guys, I'm going to stop the lesson now. Thank you for joining. Bye-bye. How did we calculate the depreciation for Chevy? Chevy depreciation. Okay, I will say that in the group now. Okay. When you say lessons, what do you mean? How much is a lesson? A course or a lesson? Message me. I will send you my number, 0784874902. WhatsApp. I'm gonna share it now. So I'm assuming on the working, so that one there. I'm going to share this the weekend when I upload the what you call it